Alright, guys, welcome to your weekly review for the 1st of April 2026. In this review, I'll just be discussing a little bit of the events that we're dealing with currently at a geopolitical level and, looking at where we could possibly draw to going forward, right? So, as most of you are currently aware, we have got the US-Iran war that is taking place in the Middle East. And we've barely seen its effects within the market. And I think it's for multiple reasons. I know a lot of traders are looking at gold, a lot of traders are looking at oil, a lot of traders are looking at the dollar as well as our index futures. And a lot of anticipations for those assets have been have failed to be met, basically. At the beginning of the war, when it started, a lot of people were anticipating that we'd have a surge in the gold price, and I let you guys know via our private mentorship and via social media that my anticipation wasn't necessarily for gold to spike, but to see us sort of sell off and dump. And that was way before we had the massive drop. It was, I think I called it exactly at the top. But yeah, there's a lot that goes into that, a lot of logic that a lot of intermarket logic that takes place into deciding that that would be the anticipation instead of a surge in the price. And that comes by way of experience. And I'm hoping to kind of share that experience through these videos with you guys. So, with the war taking place, a large deal of my focus is mainly centered on the price of oil, specifically, as well as the price of bonds, which represent the debt market for the US, and they also represent foreign and domestic faith in the US dollar, and that is why they are key. The truth is that the bond market is responsible for the pricing of all markets. All markets that are linked to the dollar and that are priced in dollars and that are influenced by dollars. So our index markets, our currency markets, our commodities, all of these things, they book based off of whatever the intention is on the bond market, right? Bonds represent a safe asset which is offered to the public by the US government, right? The United States of America. And in the event that this asset is being devalued, a lot of that money gets taken out from that market and gets poured into risk assets in normal cases, right? In the same way that people view gold as a safe haven or a hedge against inflation, these markets work in the same way. They act as a hedge against inflation, and they act as a safe haven as well, especially when the currency that they're backed by, in this case being the US dollar, is, or especially when the currency that it's backed by gains its value through trust, right? In the 1900s, President Nixon took the dollar off of the gold standard, meaning the dollar is no longer backed by the Federal Reserve's gold reserves, right? And it's more so backed by faith in the US economy or faith in the US administration and their decisions about the economy, or the Federal Reserve and their decisions about the economy. And in the case when that's the case, these markets tend to influence every single sub-market that is linked to it, being the ones that I mentioned. So a great deal of the focus is more so on bonds and the commodities that are directly tied to the US dollar, such as oil. Oil gives the dollar its value. The fact that the dollar is the world reserve currency, um, and oil is priced in dollars, would mean that oil is not necessarily backed by gold and trust alone, but it's backed by gold, it's backed by oil as well. Sorry, the dollar is not backed by gold and trust alone. It's backed by oil as well. So the the idea of this week's outlook is kind of just to look at where we anticipate bonds to reprice to, right? The beginning of this year, we opened up and we saw a surge in the price of bonds. We had some news come out during the end of last year that Japan was facing a financial crisis within their economy. Right? There's something that is known as the Japan or the Japanese carry trade. The Japanese carry trade, what that represents is the fact that in Japan they offer loans at 0% interest, right? So what individuals would do was, and this was popularized by a woman in Japan, just by the way, what individuals would do is they would loan money from Japan and invest it overseas, specifically in the bond market. If you online and if you look at a little bit of history and who the largest investors of US or who the largest holders of US debt were, you'll find that Japan was number one for many years. I think the current first place is held by the Cayman Islands, which is a US Israeli proxy. So the largest buyer of US debt currently is the US itself, right, by proxy. But for the longest time, Japan had been one of the largest holders of US debt. Now, in the beginning of this year and the end of last year, we saw that they raised their interest rates for the very first time since the 1900s, somewhere in the 1900s. And what this did is it sliced the margins, the profit margins for the Japanese carry trade, right? So we've been seeing a lot of divesting happening in terms of Japan and US bonds, right? They've been cutting back on the positions, scaling back, and that was the quote unquote catalyst for lower prices on bonds, just from a fundamental perspective and from fundamental expectations of the bond market, right? We were expecting them to reprice lower. Now with the US Iran conflict, it's kind of like watching it live. It's difficult to kind of draw an expectation of what the outcome might be of the war and who the winning side might be. Um, I mean, it's not that difficult, but one can't say for sure up until it's all said and done. So, as I said, these markets are backed by trust, and with Trump in office, a lot of people are questioning his decision making as far as this war is concerned, and the repercussions of this war on the global economy, not just on the US economy, but on the global economy. And what we're seeing is with the surging gas prices or the surging oil prices, um, a lot of markets, the not just our tradable markets, but we're talking about actual markets such as, food, commodities, whatever it may be, production. A lot of markets are going to be facing or incurring a lot of inflation because of the surging oil prices. Oil is used in pretty much everything. We are an oil-based economy globally. It's used for transportation, it's used for the manufacturing of goods, and it's used for a bunch of other things. And because of that inflation, a lot of people or let me not say a lot of people, but the human race as a whole, everyone that that earns money is kind of in need to prepare for these surging prices which we'll be facing. So, looking at the bond market and the expectations of the bonds, right? I feel as if a lot of trust has been lost in the US. A lot of faith has been lost in the US with its current administration, with Trump being in office. Some interesting decisions have been made whilst he's been there. Um, for the longest time, since Biden's term came to an end, we've been facing what I refer to as a liquidity crisis. Um, these markets are not liquid. Like, if we look at, which we will in a second, if we look at the indexes and we look at currencies, we're only now starting to see some sort of movement. But for the longest time in these markets, they've been stagnant and they've been moving sideways. The pricing and efficient delivery of these markets has pretty much been non-existent as far as that is concerned. And I feel as if a lot of people don't necessarily know how to navigate that. Um, but it comes with experience, as I said. So taking a look at the bond market, starting it off over here. Beginning of this year, we opened up. This is the 1st or the 2nd of January 2026. We proceeded to trade up higher, up into the premium level of this overall range, which we've been stuck in since this is April 2025 and this is May 2025. Right, we proceeded to trade towards the premium level of that high, towards this premium fair value gap, as well as October's high for last year. And we repriced to that level at the beginning of this year, failing to take out that high, pricing in this bearish SMT. And we've seen a rapid breakdown from that point below the sell side objectives and the closing below the sell side objectives, right? I shared this chart in the private group before we had the initial sell-off, and I was calling us lower at the beginning of the year already. We just saw a rapid repricing in order to price in, or in order to offer premium for this specific market, right? So repricing to the downside, we swept out our short-term sell-side liquidity, which formed during September of 2025, and the draw on liquidity in my eyes is the 14th of July 2025 sell side. I feel as if we'll be repricing to that area and ultimately below May's low, which is the previous yearly low as well. I think that is the intended drawn liquidity. We're pretty close to that level. It's just a matter of seeing whether we have the willingness to reprice to that level. With the inflation data coming out and us paying specific attention to the Federal Reserve and their decisions as far as rates are concerned, they cannot, by logical sense, cut rates at this time, right? So I think that rates are going to stay flat. There's not going to be any decision on that really, and we have Powell speaking tomorrow. If I can bring that up on the screen, we have our Fed Chair Powell speaking tomorrow, and I think he'll provide a little bit of insight as far as the decision on rates are concerned. So the anticipations as we head into tomorrow for I'll just get this out there now, across all of our markets is kind of for them to stay stagnant up until we hear Powell speak. But I am anticipating him to kind of stay stagnant on any sort of decision as far as rates are concerned and as far as these markets are concerned. With that being the case, if rates stay stagnant, we'll probably just see us ranging perhaps to the side for a little bit on the bonds, right? So paying attention to bonds, the drawn liquidity is still lower, anticipating us to really run the sell side and trade through the sell side objectives. I want to see us reprice to previous yearly low, and from that point we can kind of take it from there and speak a little bit more about expectations. The bonds, for knowledge sake and for transparency's sake, represent the US debt, right? So what we're seeing currently is a live devaluing of US debt. And I think that's worth noting because the US currently has the largest amount of global debt, which comes in at about 38 to 39 trillion US dollars. And their plan, I heard Putin speak about it at the end of last year, is to devalue their debt through crypto, and we might be seeing that taking place live in front of us. But yeah, that is the expectation for this bond chart. Now, with the bond charts being bearish, we want to pay attention to the yield for the specific bond, right? If the bonds are bearish, the yield needs to move counter to that. They need to seek buy side and they need to be bullish. So what we saw with the yields is something very similar on the bonds as well. Beginning or end of last year, we had us trading into the discounted fair value gap on the yields from the April 2025 low. Repriced to that level. This was SMT inside of here. We then saw us bounce from that level and we traded up into the upper premium of that range. We then retraced back to that area to price in the SMT with that low inside of that discounted gap. From that point, we've just seen a surge in yield prices. The yield represents the interest that is paid on bonds for holding bonds. I think it's paid per annum, or sometimes I think it's every 6 months or so, but in some cases with some bonds. But in this case, I think it's per annum. It doesn't necessarily matter. The yield price, how the yield price works is if bonds are being devalued and they are selling off, right? Remember what I said, bonds represent faith in the US economy and they also represent the US's debt. If bonds are selling off and being devalued and faith is being lost in the US economy, then the US needs some sort of way to reinstill faith. So just by basic intermarket knowledge relationships, if the bond price is selling off, we should see a surge in the yield price in order for them to reinstill faith in the US economy. It cannot be devalued without them offering some sort of benefit, right? Because at the end of the day, it still is an asset. It's not a liability, it's an asset, right? So we've been seeing a surge in the yield prices, and in the same way that we're looking for the bonds to draw towards the previous yearly low, I'm looking for the yields to kind of draw towards the previous yearly high, which is that May 2025 high, towards that level. That would put us at 5.115%. So that is what we're anticipating on yields. Now, the nice thing about these two markets is they sort of give you an early indication for what the dollar index should be doing, right? So the relationship between these markets is bonds move counterclockwise or counter to what DXY moves. Yields move in the same direction as DXY, but DXY seeks the yield, right? So yields are allowed to rally before DXY in most cases, and the dollar index has to seek the yield, right? It needs to move in the same direction ultimately. So bearing that in mind, we've sort of clarified that we are bearish on bonds and we are bullish on yields, which means as we go over to the dollar index and the DXY chart, that we should be bullish on this pair as well. So beginning of this year, we saw us repricing towards the sell side, sweeping out the previous yearly low, right? The relatively equal lows that existed at the previous yearly low, which formed in September of 2025. And we saw rapid repricing towards the upside after we did that, right? This is the January 16th, I think it's the 15th high that we ended up sweeping over these past 2 weeks or so, or over this past month. We traded into that, proceeded to close above that high, retrace back down into the new week opening gap that we had at the beginning of this war, which was at the beginning of this month. Repriced to that, sort of found support at that level, and then we see us repricing towards these highs again. My expectation for DXY is that it should be drawing towards the May 2025 high as well, which is in line with our expectations for bonds and for yields as well. So bullish on DXY as we enter into the next month over here and this next week as well. Anticipating bullish delivery. Now, if that's the case, and we have this case study sort of laid out for us or laid out in front of us, with the dollar index being bullish and the bonds being bearish, we can carry that over into our foreign markets that are priced in US dollars, right? So any market that has a negative correlation with the US dollar from this point onwards should be looked at as bearish. This is another reason why the gold chart, as many people were expecting it to kind of surge in price and buy, did not buy, right? Because the bonds are more important than gold. Gold is a sort of, it's not a risk asset, it's a safe asset, but it doesn't represent safety in that way. It's not offered by the US government. They cannot control the price of it. They don't own it. Right? They can control the price of it through manipulation, but they don't own it. Okay, so if you can kind of piece together what I'm saying here in terms of bonds and in terms of yields and the fact that they've been bearish on bonds and bullish on yields this entire time, you'll sort of understand why gold did not rally when most people anticipated that it would, right? So the expectation going forward is still that the DXY is bullish, and it's still that the bonds are bearish, which means that our foreign assets such as gold, indexes, currencies that are pegged against the dollar and that have a negative correlation with the dollar are going to be bearish, right? So taking a look at NASDAQ or NQ, we'll just be using the CFD chart, right? For the entire year so far, I've been anticipating that we need to reprice to some sort of discount to continue the rally higher, right? NASDAQ overall and our indexes overall are bullish markets for the most part, right? And they are bullish markets, but in order for them to continue being bullish and continue rising in price, some sort of discount needs to be offered every so often, right? And this usually occurs within the first 2 quarters of the year. They tend to offer some sort of discount. We saw that happen last year. During April, we had one of the biggest repricings for a while. That was in April of last year. I think it was this. We lost about, let's actually check. We lost about, we could say 20% of its value, or between 20 and 27% of its value during the first half of last year, right? And the expectation for this year is, or at least whilst the bonds are bearish and DXY is bullish, is that we should, in the same way, be offered some sort of discount as we head into the month of April, right? I'm not saying that it's going to be exactly the same, but as you can see, it's what we've been doing currently, and we've only seen the bearish delivery of that over these past 2 weeks or so, right? We've been trapped inside of this range for the longest amount of time. So as we break out of that range, I'm looking for us to draw towards the July low of 2025. I think that at minimum, that is the area where we should draw towards heading into this week. I had a few areas that I was paying attention to during last week and the week before, which was the February 2026 low. I wanted us to break out of that range completely and close below this low, as well as the November lows from last year, and we've seen that happening. So up until we get to this level, I'm still bearish on the indexes, on all indexes, not just Nasdaq, but YM or the Dow, as well as the S&P. So yeah, that concludes our weekly outlook for this week. I'm not necessarily giving specific levels on NQ, but kind of giving my expectations for these assets and where they should be repricing to. We'll get into a bit more detailed stuff as we head into the week. But yeah, thank you for watching. I hope this video was insightful. Up until next time, happy trading.